Okay, so casualty and theft losses. Casualty is when something is damaged or destroyed, right? Theft obviously is theft. So there are, and we're talking about personal casualty and theft losses. So we're not talking about business. Business is going to have its separate category. If you have a business casualty, and business casualty is not you lost money in your business. It's, you know, you had some sort of disaster. So in order for it to be a casualty, it has to be an identifiable event of a sudden, unexpected, or unusual nature. Now that's a really weird definition because a lot of times a casualty involves some sort of natural disaster. But some of those natural disasters aren't really unusual. Think about hurricanes in Florida. They happen every year, right? It's not unusual, but the reality of the situation is the IRS usually doesn't pick at those. They usually are okay with people who claim casualty losses from those types of natural disasters. Sudden means the event is not gradual or progressive. If the loss is due to progressive deterioration, termite damage, it's not deductible. It also is an unusual event caused by external forces. Fire, stuff like that. You have to own the damaged property. Now, with the new tax law, I call it new, I guess it's been 6 years now, they did make a change to this. You only can take a casualty loss if you're in a presidentially declared disaster area. So, your house burns down because of gas line leaks from a hurricane in Virginia. A disaster area, presidential disaster area was declared. Okay, you can take that as, that would count as a casualty loss, as a deductible casualty loss. Your house burns down because you left a candle burning, that is not a casualty loss, right? Because there was no presidentially declared disaster area. Unusual is extraordinary and non-recurring. So here they talk about hurricanes a little bit. This is the formula. So this is, okay, so first off, you gotta get over that, well, you gotta itemize your deductions. So you gotta get over that hurdle. Second hurdle is, it has to be in a presidentially declared disaster area. So that's a big hurdle as well. Then you've got more hurdles that you have to get over in order to take this, this deduction. So you have to determine the fair market value immediately before the casualty. So whatever, if your house burned down because of that gas leak, it was worth $200,000 before it burned down, that's before, minus the fair market value immediately after the casualty, maybe it's 0. All right, that's your loss. This is your decline in fair market value. So you're gonna take either the decline in fair, I think it's the greater of the two. Where is it here? Decline in fair market value or the adjusted basis of the property. Yeah, select the smaller of A or B. So in our case, we lost all of it, $200,000. The adjusted basis of our property is what? $10,000. Whoops. So we're going to take the smaller of those two. Not very generous, right? Select the smaller of A or B. Then you've got to subtract your insurance recovery. Did the insurance pay anything? Well, you got that back. You don't get a deduction for that. You take that. You subtract $100. I don't know why. Don't ask me why it's $100. And then you have to take 10% of your AGI, and only the amount over 10% of your AGI is deductible to you. Hardly anybody gets to take this. It's very rare, right? First off, I mean, most people will get insurance to cover most of those types of casualties, right? There's some information about the year. I'm not going to go through that because I'm running out of time here. Let's see. So here's an example. Tracy and Barbara purchased a personal residence in 1998 for $95,000. March 2022, the appraised value of the house was $300,000, It and most of its belongings were destroyed by a wildfire that consumed hundreds of acres in Southern California. The area was designated by the president a federally declared disaster area. The amount of the casualty loss for the house is $95,000, which is the lower of the adjusted basis or the decrease in fair market value. The decrease in, so 95, if it was, yeah. So if they lost everything, the decrease in fair market value would be $300,000. They get the whatever they paid for it. Because they received no insurance reimbursement for the damage, let's see. Losses for the personal belongings would be calculated on an item-by-item basis from an inventory of everything in the house. So they would get to take it as long as they itemized and as long as the loss was more than 10% of their adjusted gross income.
So
This,
for the, I'll never say this right, please don't laugh at me. The ratio, or, that we had like a few years ago, that would be considered.
the ratio, I'm sorry.
What's it called? The big storm we had.
Oh, the derecho.
There we go.
Yes, derecho would be, because there was, I think we were declared a presidential disaster area,
Okay.
right? Yeah.
But you said it doesn't happen often. I mean, I know we don't have like disasters.
That one would definitely fit the definition.
Okay.
Yeah, yeah. Casualty losses may be deducted in different years depending on circumstances. Usually you'll deduct it on the tax return in the year that it took place, but also you can get it can span months sometimes, the recovery efforts and losses and insurance and all that stuff. So you can deduct them in different tax years as well. Theft that occurs in a federally declared disaster area can be deducted in the year in which the theft was discovered rather than the year of theft. So you have a hurricane and then people are looting as a result of that, and you have losses as a result of the looting. Well, even if you didn't, your house wasn't damaged, if there was looting, then you would be able to claim that because it's in a federally declared disaster.
Even if you don't find it until the next year.
Yes, then the next year is when you take it, when you discover it. Let's see. What else do I want to say here? So, and this talks about the limitation again. So 10% of AGI, I mean, it's not much. It ends up not being very much for most people. And again, this is only personal property, not, and I don't mean personal use property, I mean not business property. Businesses have separate rules, okay? I think this is the form that's used for casualties and thefts. As well, you do have to describe the property, when it was acquired, and then there's the, so here's the calculation for the limitations here. So cost or basis, fair market value before the casualty, fair market value after. So the casualty here was 3,000 in this case, whatever property B was, the automobile and personal residence. So here, the personal residence, it was only a $5,000 loss because they got insurance reimbursement for most of it, I think, because they didn't have a total loss there either, and they got insurance reimbursement. But then, so 17,500 minus the $100, and then we take 10% of the adjusted gross income, $6,395 that they get to deduct from their taxes. All right, real quick. So any questions on that? I know I zoomed through that. I'm kind of trying to get through here. Yeah, taxpayer has to substantiate all of that. If the insurance or other reimbursement is more than the basis of the property damaged or destroyed, the reimbursement is a gain and you get to pay tax on it. So if your, let's see, proceeds to purchase, gain is taxable if the taxpayer does not use reimbursement proceeds to purchase replacement property. So your house is destroyed, it was worth $200,000, the insurance company sent you a check for $250,000, and instead of rebuilding a house, you just took the money and left. You've got a $50,000 gain you're gonna have to pay tax on. If you put that money back into building another house, then there's no gain. Okay? All right, last part, which is very short.